Hey everyone, welcome back to Mind Elevate. Today, we're diving deep into the mind of one of the world's greatest investors, Warren Buffett. You've probably heard his name before. He's one of the wealthiest people on the planet. But what's really fascinating is how he got there. It's not about luck. It's about discipline, strategy, and a deep understanding of how money works. In this video, we'll uncover the 7 key secrets that Warren Buffett has used to grow his wealth over decades. These principles are not just for the stock market. They're for anyone who wants to build wealth, no matter where you're starting from. So if you're ready to take control of your financial future, stick around. This video could be the turning point you've been waiting for. Secret number 1. Don't lose money. Protect your capital. Warren Buffett's first rule of investing is deceptively simple. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. But what does this really mean? It's not just about avoiding losses. It's about making sure every decision you make with your money is calculated and based on minimizing risk. One of the most common mistakes new investors make is jumping into the market without fully understanding the potential downside. They see a stock going up and they want in, thinking they'll miss out if they don't buy immediately. This mindset can be dangerous because it's driven by emotion, specifically the fear of missing out, or FOMO. Buffett, however, takes a completely different approach. He emphasizes patience and the importance of long-term thinking. If you're too eager to make quick gains, you can easily find yourself in a position where you lose a significant portion of your capital. And once you lose money, it takes even more effort to regain what's been lost. Example: imagine you have $1,000. If you lose 50% of it, you're left with $500. To get back to $1,000, you'd need a 100% return, not just 50%. This shows how crucial it is to avoid major losses from the start. Buffett's strategy here is all about risk management. He doesn't chase speculative gains or bet on stocks he doesn't fully understand. Instead, he looks for solid companies with a track record of stable growth and buys them when they're undervalued. By focusing on reducing risk, he ensures that his wealth continues to grow over time, even during market downturns. Secret number 2, develop a habit of saving. You might think that in order to invest like Warren Buffett, you need to start with a huge amount of money. But the truth is, building wealth is more about developing good habits than having a big starting sum. Buffett has always stressed the importance of saving consistently, regardless of how much you're earning. It doesn't matter if you're making $10,000 a year or $100,000. If you don't have the habit of saving, you won't be able to invest effectively. Saving is the foundation upon which all wealth-building strategies are built. Without it, you'll constantly be living paycheck to paycheck, no matter how much money you make. Start small, stay consistent. A good starting point is to save 10% of your income each month. If that feels too difficult, start with 5% or even 2% and gradually increase it over time. The key is to make saving automatic. Set up a system where a portion of your income is automatically transferred to a savings account before you even see it. One technique that works for many people is the incremental savings method. In the first week, save $20. In the second week, increase that to $40. By the end of the year, you'll have saved a significant amount without even realizing it. Over time, this discipline will provide you with the funds you need to start investing. And once you begin investing, those savings will have the opportunity to grow, creating a snowball effect that builds your wealth faster than you might expect. Example: let's say you manage to save $100 a month for the next 10 years. With compound interest and wise investments, that $100 can grow into something much larger, potentially multiplying your savings by several times. Secret number 3. Invest in what you understand. Stay in your circle of competence. One of Buffett's most famous pieces of advice is to stay within your circle of competence. This means only investing in industries and companies that you understand. Buffett believes that if you don't fully grasp how a company makes money, you're setting yourself up for failure. Too often, people get caught up in the latest trend, whether it's cryptocurrency, tech startups, or other high-risk investments, without truly understanding what they're putting their money into. The result? They end up losing money when those investments don't perform as expected. Buffett, on the other hand, sticks to industries he knows well, like insurance, consumer goods, and banking. By doing this, he's able to make informed decisions and avoid unnecessary risks. You don't need to know everything about every industry, but you should focus on the ones you understand well. Example. Let's say you're passionate about technology and follow the latest trends in software development. It would make sense for you to invest in tech companies because you're already knowledgeable about the industry. On the other hand, if you know nothing about pharmaceuticals, it's probably best to stay away from biotech stocks, no matter how attractive they might seem. Secret number 4, look for companies with an economic moat. An economic moat refers to a company's ability to maintain a competitive advantage over its competitors, allowing it to protect its profits over the long term. Buffett loves companies with strong moats because they can withstand market fluctuations and continue growing even during tough times. There are different types of moats. Some companies, like Coca-Cola, have brand moats. People are willing to pay more for Coca-Cola than for a generic soda because of the brand's reputation. Other companies, like Amazon, have cost moats. They're able to offer lower prices than their competitors because of their efficient supply chains. Buffett looks for companies with sustainable moats because they offer a level of protection for his investments. These companies are less likely to be disrupted by competitors or changing market conditions, making them ideal long-term investments. Example: Amazon is a perfect example of a company with a strong cost moat. Because of its scale and efficiency, Amazon can offer products at lower prices than most retailers, making it extremely difficult for competitors to challenge them. Similarly, brands like Apple have a brand moat. People are willing to pay premium prices for iPhones because of the perceived value and status that comes with owning an Apple product. Secret number 5, understand financial statements. This is where things get a bit technical, but it's essential if you want to invest like Warren Buffett. Understanding a company's financial statements is the only way to accurately assess its health and long-term potential. The 3 most important documents you'll need to review are the balance sheet, income statement, and cash flow statement. The balance sheet shows a company's assets and liabilities. This helps you understand how much debt the company has and whether it's managing that debt effectively. The income statement reveals the company's revenue and profits over a specific period. It tells you how well the company is generating income from its operations. The cash flow statement is arguably the most important of the 3. It shows how much actual cash the company has on hand, how much it's spending, and how much it's generating. Cash flow is what keeps a company alive, so understanding this is crucial. Example: imagine you're looking at a company's balance sheet and notice it has a high level of debt. This could be a red flag, especially if the company isn't generating enough income to cover that debt. On the other hand, a company with a strong cash flow and little debt is much more likely to weather economic downturns. Learning how to read these statements takes time, but once you get the hang of it, you'll be able to make smarter investment decisions. Secret number 6, be patient. Let compounding work for you. Buffett is a big believer in the power of compounding. Compounding is the process where your investments generate returns, and then those returns generate even more returns over time. It's like a snowball rolling down a hill. At first it's small, but as it picks up more snow, it grows exponentially. The key to making compounding work for you is patience. You won't become wealthy overnight, but if you invest consistently and let your investments grow over time, you'll see the benefits. Buffett's wealth didn't come from risky, high-return investments. It came from slow, steady growth over decades. Example: let's say you invest $10,000 and earn a 10% return each year. After 1 year, you'll have $11,000. In the second year, you'll earn 10% not just on the original $10,000, but on the $11,000, giving you $12,100. Over time, this compounding effect can turn a modest investment into a large sum of money. Secret number 7, diversify, but don't overdo it. Buffett is famous for saying that diversification is protection against ignorance. What he means is that if you don't know much about investing, diversification can help protect you from large losses. But Buffett himself doesn't believe in over-diversifying. He prefers to invest in a small number of companies that he thoroughly understands and believes in. That being said, it's still important to spread your investments across a few different industries. This way, if one sector experiences a downturn, your entire portfolio won't suffer. Example, imagine you invest all your money in tech stocks, and then the tech sector crashes. Your entire portfolio would take a huge hit. But if you also had investments in healthcare, consumer goods, and energy, the impact of the tech crash would be much less severe. So there you have it, the 7 secrets to investing like Warren Buffett. By following these principles, you can start building a foundation for long-term wealth. Remember, it's not about making quick money. It's about being disciplined, patient, and smart with your investments. Start by protecting your capital, develop the habit of saving, and invest in what you know. Look for companies with strong economic moats and take the time to understand their financial health. And most importantly, be patient. Wealth building is a marathon, not a sprint. If you found this video helpful, hit that like button and subscribe for more valuable insights on personal growth and financial success. Until next time, stay curious and keep elevating your mind.